Hey, good morning, everyone. Marty Mazzori here. It's the 19th of July, 2025, with your end of week update. I will not take too long, I promise, this morning. We'll just look at the charts for a minute. Nothing is changing, technically speaking, at least on the daily charts. And we'll make just some general comments about some of the economic data and what we're hearing so far in at least the early stages of the second quarter earnings announcements and commentary. So just again, very quickly for the S&P on the daily chart, we broke out of this bearish rising wedge pattern sideways, which does happen. Still have very definite and concerning bearish divergences on the momentum, and actually that's a sell signal on the MACD. And on the RSI, same thing, coming into or just out of overbought territory. The weekly and monthly charts, huge bearish divergences as well, and I've shown you a lot of history. These are patterns that we need to respect and pay very close attention to. Same thing on the NASDAQ 100 index, back in a rising wedge pattern, sell signal on the MACD, bearish divergence, overbought, rolling over a little bit on the RSI. These patterns will be resolving one way or another. Right now, the technicals are saying that the market is very heavy up here and very prone to something maybe noticeable to the downside over the next few weeks. As for the dollar, it continues to trend higher. This was our expectation. In fact, it was back here as well. Now that is beginning to play out. Is finding resistance on its downward sloping 50-day moving average. So we'll see. This may be all we get out of this rally. Wouldn't surprise me, though, to see the dollar gain a bit further to the upside. The data of late, on balance, is not supportive, by the way, of lower interest rates. Certainly not supportive of a Fed rate cut in July, at least the headline data. And the earnings announcements that is essentially the talk of Wall Street currently. The 10-year yield has backed off a little bit the last 3 days. Longtime viewers are very familiar with bull and bear flag patterns. So there would be your bull flag pattern. Take the length of the flagpole, which probably puts you about right there. Looks like it may be flagging down here a bit as well. We shall see. Notice this very defined bear flag here, right? Same thing, only in the other direction. Pretty much played out exactly to target if you look at where things closed. And then it bounced and so on. So, we'll see. Rising yields would, of course, be a headwind for a lot of things, particularly as we start to breach this level right here. Gold continues to defy my short-term expectations that I've been very vocal about here when we do the charts. Still in this trading range, still battling with its 50-day moving average. Gapped up a little bit, quickly filled that gap right here. Very stark, deep bearish divergences. Be cautious on gold in the short term. And I think every time I qualify that, because I am a bull, or we are as a firm, bullish on gold over the next few years if our thesis plays out the way we believe it's going to. So I think I'll pull over just briefly our notes. And this is from earlier this morning. So I would say encouraging or generally encouraging action from foreigners in May with regard to treasuries and equities. After selling in April, foreigners stepped up their purchases of U.S. treasuries in May, most of the buying from the private sector with an added $119.6 billion of buying, while the official side bought just $27 billion. What was most interesting was the behavior of Canada. Canada had sold $58 billion of notes and bonds in April, the biggest 1 month on record, but they bought back $62 billion in May. China continues to reduce its holdings, and foreigners also bought $100 billion worth of stocks. Now, I've been talking about how foreign investors had rotated out of U.S. stocks, which largely explained that big 20% dip over the course of about 6 weeks between February and April, and that the purchasing that has brought us back to these levels has been largely from retail investors in the U.S., but that foreigners still hold near record or at record quantities of U.S. stocks. Well, they jumped back in May as well. So maybe it wasn't as much the extreme retail buying in the U.S., but foreigners somewhat buying that dip, at least on the way back up as well. Whether that would be viewed as, bullish, or they're just, swing trading the U.S. market, and these are people who are now more willing to dump U.S. stocks versus where they were, say, in recent history. Of course, that remains to be seen. At 22, 23 times earnings, the U.S. market is among the most expensive markets, certainly in the developed world, if not the most expensive. The University of Michigan survey, consumer sentiment survey, came out yesterday. It does speak to the importance of the equity market with regard to sentiment. And if it does improve, if a strong equity market improves consumer sentiment, well, in a consumption-driven economy, it is very important when we're talking about the economy overall. This also speaks to what is the K-shaped economy. Now, a K-shaped economy, that's a crooked K, but you have the economy going in two directions. The upper part of the K reflects the conditions for folks who have assets and folks who are in the upper realm of the overall income distribution. The lower end of the K speaks to folks who don't own a lot of assets and who don't make a ton of money. And so Peter Bookvar talks about what I'm talking about here. Helping confidence continues to be rising stock prices, with sentiment gains among stock market participants. However, those without stock wealth experienced a sentiment decline. For non-stockholders, sentiment is at virtually the same level as the low of last year. The bottom line for the University of Michigan, sentiment trends this year have been driven by the evolution of concerns over tariffs, primarily due to concerns that trade policy would worsen the prices consumers face. Moreover, consumers' expectations over business conditions, labor markets, and even their own incomes continue to be weaker than a year ago. That said, the recent 2 months lift in sentiment suggests that consumers believe that the risk of worst-case scenarios that they had expected, at least in April and May, have eased. Okay, and then lastly, with regard to the notes, let's just take a quick look at this is from Macro Research Board, and it basically supports the narrative that the new act will offset the negative of the new tariff regime, which we really don't know what it's really going to be going forward just yet, so there's that uncertainty. But apparently the Congressional Budget Office estimates that the act could stimulate GDP by 1% next year. This stimulus will be enough to offset the negative impulse of the trade shock next year. For context, the Yale Budget Lab estimates that the trade policy shock is dampening GDP by 0.5 to 1% this year. The trade drag will lessen on a sequential basis next year, provided that trade policy does not become even more restrictive than assumed. The overall combined policy backdrop will become more growth supportive next year, so that we're looking out into the relatively near-term future. But again, it is contingent upon the trade policy not becoming more restrictive. I'm not saying that any of this is our base case. If you're thinking about it in terms of equities or stocks, which is what most people think about a lot, their narrative, or this narrative, if you will, is just not supportive of a decline in inflation. And it's not supportive of the Fed getting aggressive in terms of rate cuts later this year. In my view, we are unequivocally late cycle, and there's still more to play out with regard to all of this. And then lastly, and I'll leave you with this, if you listen to the bank earnings commentaries, you would not remotely believe that the Fed should be cutting interest rates anytime soon. For example, I'm just going to paraphrase for you. Bank of America, we continue to see solid consumer spending data, improving credit quality, plenty of household net worth growth in the market growth. So I guess folks have more in their 401ks because the markets come back. And also the account balances, again, staying strong above where they were pre-demic. Also, we see solid commercial loan growth and good credit quality. So Bank of America is singing a really rosy tune, frankly. From J.P. Morgan, Jamie Dimon said, we continue to struggle to see signs of weakness. The consumer basically seems to be fine. Now, a few things are true, like If you look at indicators of stress, not surprisingly, you see a little bit more stress in the lower income bands than you see in the higher income bands. That's pretty much definitionally true and nothing out of line with our expectations. Also, our delinquency rates are also in line with expectations, and he goes on. Citigroup, now let's turn to the environment. Well, it's proven to be more resilient than most of us anticipated, but we aren't dropping our guard as we begin the second half of the year. We expect to see goods prices start tipping up over the summer as tariffs take effect, and we have seen pauses in CapEx and hiring among our client base. All of that said, the strength of the U.S. economy, driven by the American entrepreneur and a healthy consumer, has certainly been exceeding expectations of late. As I've been speaking to CEOs, I've yet again been impressed by the adaptability of our private sector, aided by the depth and breadth of American capital markets. From Wells Fargo, as we look ahead, what we see regarding the health of our clients and consumers has not changed. Consumers and businesses remain strong as unemployment remains low and inflation remains in check. Credit card spending growth softened very slightly in the second quarter, but is still up, and it goes on. So now there are a slew of companies that are concerned, and their earnings statements are reflecting that. But if you listen to the banks, and they're very important to listen to, and they tend to sound a pretty rosy tone. Jamie Dimon can come out and be pessimistic when he needs to. Brian Moynihan, forget about it. That guy is almost always a cheerleader for the economy. But when you think about that, earnings season has begun, and we've really gotten nothing out of the market. You can see the last week there's 5 days, and just a very moderate uptick, but still stuck in this range. So nothing they're saying is allowing the market to go, barreling to the upside from here. And that, in my view, is because there's nothing about what they're saying that supports the Fed getting very accommodative going forward, right? So here we are with very high valuations. It's almost like the market would celebrate some weak numbers and therefore begin to discount, Fed rate cuts. The market tends to do better, frankly, when the news isn't so good, right? So now that the news is sounding a little better. I haven't scored our index yet. I'm going to do that next, but looking at all the data during the week, I can tell it's still going to come in somewhat in the red in terms of general conditions. But there's nothing there that's just flashing imminent recession. And the data is saying, underlying inflation isn't going away. And commentary, the likes of which I just read to you, is saying, we're not in bad shape. So that's been my caution to the administration. Not that they can hear me, but my caution is be careful what you ask for, because if you cut rates into this setup, you may have the scenario you had last September when the Fed cut rates into a setup which was not suggesting that the economy's rollover is imminent, and you got mortgage rates jump a full percentage point. So we need the economy and interest rates to lead the Fed. We don't want the Fed to get in front of it because it can backfire on you. I will leave it there, folks. Thank you, as always, for watching and listening. Be back next week. Take care. Bye-bye.